going to continue on now with the next section of this chapter. We've already talked about the petty cash. Now we're going to talk about the bank reconciliation. I've already written some of the information up on the board. This is information that is explained in detail in the book. The book does a very good job, but I realize that sometimes just reading something, you might not pick up on something, whereas if the instructor is teaching you it, explaining things as you go along, sometimes that's helpful. So that's what I'm going to do. I'm going to go through this bank reconciliation, showing you some examples of adjustments that need to be made. So the first thing we need to realize is that every month, businesses should reconcile their bank accounts. They're going to get a statement either online or through the mail from the bank. And some of you may have a bank account and realize how this is done or have seen how this is done. So if you get your bank statement, you just write down whatever the ending balance is on your bank statement, and then you'll go to your books. Okay, you're going to go to your general ledger account, or I'm sorry, your cash ledger account, and pick up the ending cash balance on the ledger. So now you can see that these balances don't reconcile, they're not equal. And there's a good reason for that, because there are some things that are on our books that haven't cleared the bank, haven't gone for the bank. The bank can't record them if they haven't received them. And the same is true over here. The books may not have some transaction that the banks may have charged already. There might be a mistake they've made, or possibly they've received some money that we're not aware of. Interest may have been earned, bank service charges. So there are items that are not on one side that need to be put on the other side, and some that are on this side that are on the bank statement that aren't in our books yet. So basically it's just kind of an investigative thing, looking at both sides, looking at the bank side, looking at the book side, and seeing where the differences are, where things are missing. So we're going to start with the bank statement side. Some typical things here to add back would be a deposit in transit. Okay, a deposit in transit. And a deposit in transit just means that we've deposited it probably the last day of the month, but you know, if you come in, if you go into the bank late, maybe at 4 or 5 o'clock, they don't post it till the next day. Well, you put it on your books, but they don't have it on their books. The very next day they should, but on this bank statement, it just might not be there. So that would be a deposit in transit, and that is for $145. So that's something we're going to add back, so we'd say plus $145, because that's what the example is in the textbook. Some deductions, well, the most typical ones are outstanding checks. I'm just going to abbreviate that O/S. What this means is it's a check that we've written that hasn't cleared or hasn't been cashed by the bank yet. So we deducted it from our books, this check, but the bank hasn't received it yet. So if they haven't received it, they don't know the dollar amount and they can't take it out of our bank. Well, if it's deducted out of here, we need to deduct it over here to get this to reconcile, because our ultimate goal is to get the adjusted bank balance and the adjusted book balances to equal out. So there are two outstanding checks, number 124 and 126. 124 is for 150, 126 is for 200. So together they total $350, and that is a subtraction. So those are the only adjustments that need to be made to the bank. So then our ending bank balance is $1,845. $1,845. So now we're hoping that we can get that same balance over on this side. Okay, for the book side, we're going to add back a collection. What happens sometimes is we tell people that owe us money not to send the payment to us. Sometimes we have arrangement with the bank and we tell them, just make the payment to the bank. Tell them you're paying it on behalf of yourself to our company. And then they just put it right into our bank account. Okay, so that's what's happened. One of our customers, someone has paid money to us. We were not aware of it yet. So that's why it's not in our books. Okay, but it's on the bank. So what happened was the bank collected $500. It's in this. They charged us, it looks like $15 to receive that money. Okay, so what this is they call it a collection on the note. Collection dash note it's for $485. Because remember, they charged us $500. I mean, they put in $500, and the bank charged $15. So we really only received $485. They only gave us credit for $485. So we need to put that on our side because it's not in this balance. Another item they have down here is interest. Oftentimes our checking accounts earn interest. We don't know what the interest amount is until we get the bank statement. So when we look on the bank statement, you'll see interest earned. So over here, we're going to put down, I'm going to abbreviate interest earned. So on the bank statement, you'd go and you'd see that. And it says here that it's $8.42. Okay, so these are both additions. So I'm going to put plus signs there to make sure that we add that in. Some deductions, check printing charge. Okay, so we must have printed some checks. And when you print checks, you usually don't know the amount until you get the statement. The statement shows the dollar amount. That was $23, and then an NSF check for $30. So 23, and then I'm going to put 30 here for an NSF check. Okay, in this case, the NSF check plus the service charge. So someone paid us, we deposited the check at the bank, their check bounced. So if their check bounces, they take the money out of our bank account. Well, we had put it in here with the deposit. We now have to subtract out that non-sufficient fund, NSF, non-sufficient fund check. So we subtract that out. So now when we add these two, subtract this out, you will see that we get the same balance. So now we're done with our reconciliation. Well, almost done with the reconciliation. What we have to do now is these items here are not on our books. So we've got to put them on our books. So we have to record the journal entry. This one here, these are additions, so we're going to debit cash. In this case, we're going to debit cash, the $485. There was a $15 collection fee, so we'll debit a collection fee expense for $15, and then we will credit the note receivable for $500. Interest earned, we'll debit cash $842 and credit interest revenue for $8.42 because we earned the revenue. Down here, this check printing charge, well, now let's see what the book calls it. We're definitely going to be crediting cash, and the debit will be to, they call it miscellaneous expense. So just a miscellaneous expense for $23, and then the credit is to cash. And then the NSF check, we're going to debit an accounts receivable. Whoever owed us the money, their check that bounced, we've got to establish that accounts receivable. And this is going to include the NSF fee also, because this $30 includes it. So we're going to debit accounts receivable for that person, and then credit cash $30. So basically what we've done now is we've recorded these 4 entries, so our bank balance, our book balance is really now $1,845. We do not have to record these entries because these are already on our books. These are on our books. And what they're missing though from the bank statement balance. And hopefully next month they will clear the bank and they'll be recorded on the bank statement balance. Okay, I realize bank reconciliations are tough. You need to spend some time going through this section very carefully. There's a demonstration problem that does a good job, and then your B problem. So good luck with reconciliations.